Hi, everybody. Good afternoon, or wherever, different time if you're in a different part of the world. Welcome to this webinar hosted by the Carbon Tracker Initiative on powering down gas. This afternoon, we're going to be looking at the role of power sector gas in the energy transition. My name is Philippa Nuttall, and I'm Environmental and Sustainability Editor at the New Statesman. So to kick us off this afternoon, we're first of all going to hear from Jonathan Sims and Lorenzo Sani, who are both analysts at Carbon Tracker, and they're going to be talking to us about the report that they have published on powering down gas. If any members of the audience have any questions either during this session or at any time this afternoon, then feel free, please, to put your questions in the Q&A. So Jonathan and Lorenzo, over to you.
Thank you, Philippa. I'll be sharing my screen now. I hope that everyone can see it. Okay, so welcome everyone. Today we will present you the results of our report Put Gas on Standby, where we analyze the profitability of operating and future gas plants in Europe and US, and where we found that the window of opportunity for gas power is quickly closing, and gas is moving from being a bridge fuel to a stranded asset. In this presentation, I will introduce you our model, and then Jonathan will guide you through our results. So our model. All our results are based on the findings of our global gas economics model, where we look at every single plant with an asset level perspective. So we are looking at almost 100% of operating plants in Europe and US, and more than 90% of future gas plants that are currently under construction in the region. Then to this database, we add our country-based assumption on commodity prices, power prices, electricity subsidies, and so on. Then we have our in-house model for the cost of renewables. We look at different climate scenarios, and we perform a sensitivity analysis on some key inputs, such as fuel costs and carbon price. And all of these allow us to look at our results from an asset level perspective, where for every single plant that we analyze, we can model future costs, future revenues, we can understand the phase-out dates under climate scenarios, we can calculate project finance indicators, and so on. And then we can aggregate our results either at company level or at country level, as we're doing in this report. And Jonathan will tell you all the results that we found at country level. And before giving him the words, I will do a quick dive in our renewable cost database and our stranded asset calculation. So we are modeling renewable costs for current renewable costs and future cost reduction for solar and wind. We're starting from a very granular bottom-up approach. So we're looking at technical potential, local resources, latest PPAs signed in the regions we're looking at, so that we can calculate the most recent costs that we're seeing in every region. And also we are taking in account the future deployment rate and learning curves for the different technologies to understand future cost reductions. We also very recently added a calculation of renewables plus storage, where we are modeling a 4-hour lithium-ion battery. And this allows us to also understand, to model a renewable solution that is coupled with battery storage, allow us to understand a technology that has a flexibility service similar to the one required for 2 gas turbines. Then moving to our stranded asset risk calculation, this is essential for us to understand the economic impact of early closures of gas plants. As you can see in this chart, we are showing the gas capacity of Germany under the 3 different scenarios that we model. In gray, business as usual, then in blue, beyond 2 degree scenario, and in red, net zero. Both our climate scenarios are taken from IEA models. And comparing, what we do is that we compare the difference between the business as usual capacities and the climate scenarios in order to understand the stranding capacity. And then we can compute the difference in profits under business as usual and the climate scenario in order to understand the stranded asset risk. And this is the key to understanding the economic cost of phasing out earlier the gas fleet. And now I will let the floor for Jonathan.
Thanks, Lorenzo. So yes, I'm very happy to present the key findings from Carbon Tracker's first flagship gas-focused report, Put Gas on Standby, which we published back in October. This report presents a clear picture that although the use of gas-fired power stations may continue to be required in some form as backup capacity to both European and US power grids, the days of long-term profitable returns for investors from such assets are already over. I'm going to expand on the points listed here in subsequent slides, so I won't dwell too much on them. But in summary, our view is that although gas units are playing a valuable role during the early stages of the energy transition in facilitating the closure of more polluting coal-fired facilities and the rapid integration of renewables without creating security of supply issues, the long-term use of fossil fuel-fired power stations of any form without abatement technologies installed will make legally binding climate targets already in place completely unachievable. We therefore find that gas unit closures are likely to be forced by policymakers before the end of planned lifetimes, leaving significant levels of potential profit at risk of stranding, while profitability may also fluctuate wildly depending on movements in volatile gas and carbon markets, meaning potential crunch points for gas plant owners may arrive even earlier than currently projected. Many investors seem to continue to view gas as the bridging instrument in the energy transition that has a free pass to the future. But we believe this would be a misguided approach to take and urge such parties to acknowledge that gas will not be immune to the economic challenges facing coal. Next slide, please. So why exactly are we now turning our attention to gas? As we can see on the slide with gas represented in the black line, steep reductions in emissions from coal, represented in yellow, and lignite in red, have now left gas plants as the European power sector's largest single source of greenhouse gas emissions, meaning that the policymakers' attentions are rapidly turning to how this pollution source can also be tackled to ensure climate targets are to be achievable. The slight reduction you'll be able to see in 2020 emissions was solely down to the COVID-driven decline in power demand that we saw last year, and output is forecast to have resumed its increase and return to around 2019 levels this year of roughly 250 million tonnes of CO2. The clean fuel label that gas has sometimes attracted in the past is outdated. The sector emits more CO2 within Europe than the steel and chemicals sectors combined. And although we continue to acknowledge that gas units may have a medium-term role to play within the transition, it is clear that levels of policy risk for investors within this sector are rapidly growing. Next slide, please. So if we look at how the economics for gas-fired power generation currently stack up, here we show the proportion of gas capacity that is estimated to be unprofitable to operate today in the navy blue, and the projected figure for 2030 in red. We are already witnessing the same initial trends for gas that we saw for coal in Europe around a decade ago. Rapid increases in the availability and improvements in technology for renewables are increasingly squeezing gas plants' operating hours, while carbon prices are now at levels which are beginning to have an impact upon gas plants' operating margins as well. Emitting power stations inside the EU now have to pay more than 70 euros for every tonne of CO2 that they produce, with this price level having risen more than tenfold in just 4 years. Our models estimate that just over a fifth of European gas-fired power capacity and more than a third of US capacity is already unprofitable to operate on paper, where we project these figures will rise to 33% and 37% respectively by 2030 under business as usual. Next slide, please. So on this slide, we show our estimated median operating costs associated with continuing to run Europe's existing gas plant fleet over time in black, and then projected investment costs for new onshore wind capacity in red and solar farms in yellow. And as you can see on the left-sided chart, our cost comparison analysis found that renewables are already comfortably cheaper investments than continuing to run existing gas. Investment costs for renewables will continue to fall over time as widespread deployment pulls down costs through economies of scale. And this contrasts with expectations for rising costs for gas plants amid likely gains in the cost of carbon, as well as steeper operational and maintenance costs over time. Shown in the chart on the right, we also then included the addition of estimates for battery storage capacity installed alongside such renewable assets to make the comparison with gas fairer. And our results for this show that although the extra costs of battery storage do move the point at which new renewables become cheaper to operate in Europe than existing gas further ahead. By the end of the 2020s, onshore wind with storage will still be cheaper to operate than running gas, while solar will then follow during the early 2030s. Next slide, please. So here we show our stranded asset risk figures for existing gas units and the amount of operating profit which could be lost owing to forced unit closures earlier than planned if plant owners do not plan sufficient winding down strategies long in advance. In the navy blue on the chart, we show the amounts at risk under the IEA's beyond 2 degrees scenario, while the red bars show what happens to stranding risk when the even earlier plant closures are driven by policymakers for alignment with 2050 carbon neutrality. We found that a combined total of around $16 billion in potential operating profit would be at risk of stranding under net zero, as such assets are forced to close well in advance of planned retirement years. Incidentally, on the other hand, for those already loss-making plants, we project that the earlier end to their lifetime brought about through policy aimed at net zero alignment would save both European and US operators around $8 billion each in potential losses. Next slide, please. But despite the economic outlook for gas, extensive pipelines of new build capacity remain across both Europe and the US. We find that more than 60% of the non-CHP plants planned for Europe and the entirety of non-CHP capacity planned for build in deregulated areas in the US would be unlikely to recover initial investment though, as reduced usage over time means revenues are insufficient to pay back debt. And as you can see on the chart, this leaves close to $25 billion of potential investment at risk of value destruction under business as usual if the country's entire pipeline is built in the US. The fact that the projections under the beyond 2 degrees scenario and net zero scenario slightly improved might seem counterintuitive, but this actually reflects the extent to which these units will struggle as an earlier end to their lifetime will reduce the number of years of loss-making operation. Italy's pipeline of new gas plant projects, however, is projected as likely to generate a positive net present value, as shown on the 3 middle bars on the chart here. But as I'll show on the next slide, even this pipeline is relatively fragile and vulnerable to becoming largely unviable in the event of changes in market conditions. So just finally here, we show the results of our sensitivity analyses depicting the impact of changes in capacity market payment and carbon price on the projected net present value of Italy's planned pipeline of new gas. The red central bars represent our projection under our base case assumptions, while the green bars represent how the NPV is impacted by changes in percentage level for these two metrics. And as we can see on the left-sided chart, Italy's capacity market mechanism, which provides payments to generators in return for providing grid reliability and supply services, is largely responsible for the country's gas plant pipeline being NPV positive. And as you can see on the far left-sided bar, if these payments were not in place, the NPV would be comfortably negative. But on the other hand, this chart also shows that the level of these payments in Italy could be reduced by at least half, and the NPV would still remain positive, meaning developers will be overly compensated and funds could actually instead be freed up to support low carbon tech innovation or other initiatives aimed at strengthening grid stability. On the right-sided chart, we show the impact that a further increase in carbon price would have on the economics of Italy's planned pipeline. You can see that a 75% increase in CO2 costs from our base case assumptions would pull the NPV into negative territory. Incidentally, our base case carbon price assumption for this year was an average price of 50 euros a tonne, which, whilst being relatively accurate for a forecast average price over the entire year, compares with current market levels, which have traded around 75 euros per tonne this week, which our base case assumptions for this project were not scheduled to reach until 2030. Thanks very much, and looking forward to the panel discussion.
Thank you, Jonathan and Lorenzo. And I think your statement there that you cancel your new build gas projects or lose your investment is a fairly stark statement. So I'll be interested to hear what both our respondents have to say. So I know there are lots of questions already, but we'll hear from our 2 respondents to the report, and then we'll come back to the questions in a minute. So first of all, we're going to hear from Lisa Fisher, who is Programme Manager for Energy Systems at the climate think tank E3G. Lisa, the floor is yours.
Thanks so much, Philippa, and thanks, Lorenzo and Jonathan, for the presentation. This report is really interesting, and I think sends some really stark messages. So very happy to be here. And I just wanted to sort of share three reflections. I think the first one really chimes with what you, Lorenzo and Jonathan, said. Gas and power is really heading into a situation of life support. Possibly in some instances it already is. It's perhaps benefiting from hedging in the past, but it will increasingly become dependent on government intervention. The sort of regulatory risk element of any investor's transition risk analysis will become much more significant, I think, when looking at gas projects. So this is one of the key takeaways for me. And that essentially past decisions and current decisions on gas infrastructure and gas power plants mean that we're starting to be locked into an inflated and inefficient system. And I think that we need to turn that around. My second takeaway really is that this report puts us in a good place to start talking about how to manage the wind down of this system, this overinflated system. I think you're bringing some really good and interesting data points to the table. I'm sure there will be questions around the data points and different viewpoints, but I think starting this conversation about the wind down and looking at where does it make sense to really downsize, right-size the system, align it with our objectives on climate, but not only really align it with fundamental economics of the systems. I think this is where this report is really valuable. And also, I think the other element related to this is really around some of the tipping points you're highlighting that we really need to watch out for. So when is it that renewables and battery storage will become cheaper? And this is when we might start to see very fast developments in the market, and we really need to get ahead of that. And before I get to my third point, just some pointers at things we probably need to do to start managing this risk. I mean, the first thing is to really stop the expansion of gas and power. A really live discussion in Europe, and I think emerging discussion in the UK as well, is around how to talk about gas in the context of sustainable finance. I think your report is a really valuable contribution to saying actually it's not only not sustainable in climate terms, it's also not sustainable in economic terms. So it makes no sense to be included and signal to investors as a sustainable investment. I think we need to think about how do we give utilities the incentives to switch from electricity provision through gas to other services in the system. So we need to think about also incentives and business models here. And we need to think beyond money. I think I'm obviously not familiar with the whole of Europe, but in some places like in Germany, utilities are really important at local level, are entangled with the local economy. We've seen that in the coal exit. It's really important to look at it from a systems point of view and manage this process well, and not just leave the transition to happen in a messy way, which then has impacts on local economies. And we also need to think of the broader ecosystem. Obviously, in Europe, at least, gas and power isn't the largest consumer of gas in the overall system, but it's nonetheless significant. So I think around 1/5 of gas consumption. So, if we start talking about reducing gas consumption in the power sector, this will have implications for utilization rates of pipelines, and so on and so forth. All of that links to the consumer bills at the end. So we really need to think about this in the broader ecosystem and broader decision-making around infrastructure. And just my last point very quickly to finish up is, I think it's really clear that we should not lock the consumer into higher prices through overcapacities. I think your report makes really clear we can no longer hide behind uncertainty around the energy system and energy transition. We actually know more and more where we're going and what that means for, in particular, coal, and even more, and I'm starting to understand much better what that means for gas. So we can't hide behind that uncertainty, and we can no longer justify investing in gas on climate grounds. It's really hard to invest on it and justify investing in it on economic grounds. And it really means that if you as an investor still want to invest into gas and still have a proposition to build out gas and power, your arguments need to be pretty good, because a lot of those, like on economics and climate, no longer stand up, and they need to be really good to then ask for consumers to help you fund this in the longer run. So I think there is something where this report really starts flipping the burden of proof, and really says, well, this is not the pathway that makes sense for the consumer. It doesn't make sense for the economy. It doesn't make sense for the climate. So there needs to be a massive reason to do that, that we haven't heard of yet, if we still want to build out gas and power. So I'll stop here and looking forward to the discussion.
Thanks, Lisa. So you're fairly well in tune with the report, it seems. So now we're going to hear from Vesa Ahuniemi, who is Strategy Manager at fore up in Finland. And yeah, let's hear your response to the report, please.
Yes, hello, and good evening from my point of view, and probably for most of you, it's more like afternoon, even though for Finland, it doesn't really make a difference in terms of how bright it is outside. It's dark after 3 o'clock. Anyway, many thanks for inviting me to take part in this panel and comment on the report. I think the role of gas should indeed be discussed more, both at national and European levels, because from my point of view, gas is in many ways is actually at the center of the transition now underway in the power sector. Before I get into sort of more broader points, I would like to briefly comment on the report in question, specifically on the methodology used to model the profitability of gas plants, since I have some expertise in that field. Thankfully, I had a chance to get acquainted with the methodology used. And given the fact that it's basically the report uses volume and price scenarios that are completely unrelated to one another, I don't think actually it's quite robust enough to support most of the key findings that are presented in the report. And from my experience as well, it's not a methodology used actually in the industry for valuing assets or doing any kind of impairment testing. But I certainly encourage anyone using the report to find out more about the methodology and make their own judgments. All that being said, the report, I think, certainly touches upon a key topic, which is the role of gas in energy transition, especially in the power sector. And I think too often the energy transition is presented simply as sort of quite a simplistic process whereby you simply build renewables, mainly wind and solar, and close baseload or dispatchable capacity like coal, oil, or gas, and sometimes even nuclear, which is quite peculiar. There is truth to this, obviously. At some level, this is what happens. But actually, the reality on the ground, when you look at how the power system actually operates, it's actually far more nuanced and interesting. The massive influx of solar and wind put the system in a completely different mode than maybe 10 years ago was the case. Because now you have, across Europe, you have tens, and in the future, probably even hundreds of gigawatt shifts in the renewable generation, just from one day to the next. And these kind of massive volumes have to be balanced somehow. So there's a huge need for flexibility in the system, because you always have to have the equal amount of generation and consumption. There's a huge increasing need for flexibility, and this need for flexibility will actually remain also in the long-term power system, and certainly will remain the case in the midterm future. And the system also becomes more complicated, and this is quite tricky, because when the system has a lot of renewables, variable renewables, using metrics like LCOE to compare technologies to another is actually becoming less and less useful, because these technologies serve completely different needs in the system. So you have bulk generation, which is wind and solar, and then you have dispatchable generation, which is things that you can dispatch at will. And these serve different purposes, and therefore using LCOE, or levelized cost of electricity, is actually quite difficult. The capability of gas plants and the whole gas system to balance these shifts currently is, from my perspective, actually what allows more renewables currently being added to the system, while also phasing out coal and oil, leading to the kind of emission reductions we have seen in the past, let's say, 5 years. And to put this into numbers, the EU gas demand in the power sector has risen something like 20% in the last 5 or so years. And in the same period, the EU power sector emissions have actually fallen by something like 40%. And I'm sure we can all agree that this is quite compliant with Paris Agreement and all different kinds of scenarios. And this has been made possible in part by Europe's around 200 gigawatts of gas-fired capacity that was in the past largely idle, and then they could be taken into use as coal was sidelined. And this is a good thing, obviously. And one might describe this capability of gas with the word backup, as the report does. And although I would call it flexibility, but I think the meanings are actually pretty much the same or quite similar. They signal dependability and high importance. And this is still likely to be the case in the midterm future as well, even though gas will certainly move towards less emissions and, in the long term, towards hydrogen, from my perspective, and many other solutions. So to wrap up, even though I disagree with most of the findings of the report, I certainly think that the topics raised and the questions raised are extremely important, and I think they reveal crucial and often, frankly, overlooked aspects about the energy transition now in process and taking place. And certainly the report is worth studying. Thank you.
Thank you, Vesa. So I think to kick off the panel discussion then, I'd like to ask Lorenzo if he would like to defend the methodology in any way or come back on any of the points that Vesa has just made, in terms of that your report raises lots of good questions, but it perhaps doesn't come up with quite the right answers.
Of course. Again, thank you, Vesa, for your comments. And we really want to try to expand even how we model stuff. Like it's important to recognize that this is the first time we're expanding our modeling to gas, and it's the goal of this report was to give a first snapshot of how the situation is looking in, and then we're gonna expand with the country level analysis for Europe and US, and also for Asia. But a couple of comments. I understand some of your comments, but in our model, in our methodology, we acknowledge the importance of gas as a flexibility provider. In fact, how we phase out plants is that we always phase out last the more flexible plants, as in open gas turbines and the plants that can quickly provide flexibility service. What we are really trying to highlight here is that what we see in Europe is that there is a large pipeline of very large combined cycle the gas plants that of 700, 800 megawatt size. And we don't understand why those are sponsored as a solution for the flexibility issues we're facing, because those plants are notoriously not as flexible as what we need now with all the issues that you highlighted with the higher penetration of renewables. And so what what we think is that more thoughtful approach should be given to especially those type of plants that represent the majority of the new gas plants that are in construction in EU. And also, yeah, we believe that even though in a initial phase, investing in renewables plus storage, demand response, and similar flexibility solution could be more expensive than just building a gas turbine. It can definitely create the technological innovation and learning curves that we need to deploy this technology at scale and to reduce the cost in the longer term. So yeah. That's my response for now.
Thanks, Lorenzo. We won't focus too much on that. Otherwise, I feel we probably spend the next half an hour talking about the methodology. And I'm sure that if anybody listening has got any questions, if they contact Lorenzo afterwards, he'd be happy to answer their questions. I wanted to start with the bottom of the pile of questions, or it was the bottom before the pile of questions we have, where somebody's asking, why are utilities still investing in new gas-fired plants if the alternative energies without battery storage is so obvious? Jonathan, perhaps you could shed some light.
Sure, of course. So we believe gas is still being built, sort of regardless of the economics. The reasons for that is a combination of factors, really. The primary ones being the availability of financing for renewable projects via capacity market mechanisms, and also project developer reliance upon future technologies such as CCS and hydrogen. As I showed on the final slide of my presentation for Italy, capacity markets can offer very attractive long-term guarantees of 15 plus years for payments to new build gas projects in return for grid supply reliability services. But we still believe that heavy reliance on those out-of-market revenues would be misguided. Our model assumption for capacity payments is pretty conservative. We've allocated capacity payments throughout projected plant lifetimes for the majority of planned units at the price level currently awarded, unless a country has specifically identified a planned end date for issuing capacity contracts. But the reality is that these schemes are already being reviewed and restructured, with emissions limits having been introduced to prevent coal from being awarded, and countries, including the UK and Italy, having now allowed renewables to compete for contracts at derated capacities, etc. So not only is competition for these contracts increasing, but that is driving down the level of payment that is awarded at auction. While you would think that there is a good chance that member states will come under pressure to reduce funding to unabated gas plants over time. So although we fully acknowledge that capacity markets may be a necessary feature of power markets in order to ensure security of supply, we do not think that the entirety of the capacity contracted under these mechanisms is likely to be gas-based, and any that is will steadily reduce over time in favour of other forms of flexible supply in order to ensure policy alignment with long-term climate targets. And this could mean that project developers get to the end of their 15-year agreements and find that A, the level of payment available to them for future years is either significantly reduced, B, they are outcompeted by other technologies, or C, unabated gas units are no longer eligible at all for capacity market funding as either EU or national law governing this has changed over that period. And this would leave plant owners who had planned for a 30-year lifetime for their asset with significantly reduced revenues for the second half of that period. On the future technology side, we're seeing an increasing number of projects proceed because they're either CCS or hydrogen ready. We believe that this is a very risky approach to take, however, given the low levels of power sector deployment that either of these technologies have so far achieved, and feel that pressing ahead with development in the hope that one of these technologies will eventually evolve sufficiently to support the long-term viability of the asset beyond the point at which unabated gas might be forced out appears unwise at this stage. We're not dead set against either of the use of either of these technologies as such, but just believe that as things stand, they appear more likely to play more impactful roles in the sectors that are hardest to abate and which have a longer period of time in which to decarbonise than the power sector. And so just feel that investment in new build projects which are going to be reliant upon them is very risky. And just finally, beyond those two factors, we also think there's a general tendency for policymakers to revert back to conventional forms of supply that they're familiar with in order to ensure security of supply and to continue to turn to gas. But governments are struggling to achieve their climate targets, and we think that they would largely be willing to adopt better solutions if they are presented to them. And that's where the market should be proactive in putting them forward and offering them, pushing demand-side response initiatives, supporting battery storage adoption, etc.
Okay, and so, I mean, are you suggesting a vision, therefore, whereby we can get to net zero essentially without CCS? Because in most scenarios, we see CCS is there as to enable us to get to net zero.
So we're not dead set against CCS. We just feel at the current point it's looking like a pretty risky strategy to rely upon it. That may change, but as things stand, it's looking like it's more likely to play a more impactful role in the sectors that are hardest to abate. I think plant operators that rely upon the tech being available could eventually reach the latter part of the 2030s and find that it still isn't available to them, and all the costs involved are too high, and meaning that they're forced to close their unabated assets long before the end of planned lifetimes. I think the technology has been viewed as a bit of an escape hatch for the fossil fuel sector, and an excuse to continue burning and polluting on the premise that one day, although all of those emissions will somehow be captured. But the simplest way to address the issue is to reduce output and accelerate the deployment of renewables. And whereas CCS, as I say, might have a role within other sectors, it should not be viewed as a solution for the power sector. And I think it really, if there was any real confidence amongst utilities in CCS evolving sufficiently as a solution for the power sector, we would not have seen so many coal plant closures in recent years if a clear decarbonisation tech solution was near to being delivered. And the same mentality should be applied to gas.
Okay, thanks. And Vesa, is this a scenario that you would agree with in terms of CCS and gas? And then also perhaps you could talk to us a little bit more about how you see hydrogen and whether hydrogen is changing the game in terms of the role of gas in the transition.
Yes, certainly. Thanks for the question. I think there's basically two quite separate issues here. So we have security of supply that is very much a short-term, medium-term, and long-term issue. And then there's the last terawatt hours of electricity generation that have to be decarbonized, right? So the last, let's say, 10% of generation. And if you look at sort of industry or even mainstream models, you do see quite a lot of CCS or hydrogen used to decarbonize the very last points of the supply curve, or the very last sort of terawatt hours that have to be produced when there's no wind, when there's no solar production, and demand is probably high. So that's kind of just a feature of the energy system or the electricity system as people typically see it now. I think lately the momentum for CCS has mostly been on the industry side. So you see industry, for example, in cement, investing in CCS because there's not a lot of abatement measures in cement rather than CCS. Some in waste to energy as well. Not that much, to be honest, on the power sector. I think in the power sector, when it comes to these last terawatt hours of electricity, the focus is much more in hydrogen. And what is important to understand is that hydrogen is, of course, not only for the power sector. It's quite a big sector that is now being developed, and there's a lot of strategies and a lot of subsidies and a lot of interest going towards that, because hydrogen is a great way of decarbonizing not only industry but also the last terawatt hours of the power sector. So indeed, I do see hydrogen as quite a big play in the future, and certainly the current gas fire capacity, and certainly any future gas fire capacity that is being built will certainly be built with the eye of then being able to convert that same infrastructure for hydrogen. And that is, for example, what the new German government coalition has highlighted in their report. They say that, well, gas is indispensable, but of course all gas capacity that will be built will need to be hydrogen ready. And I certainly agree with that.
Okay, thanks. Lisa, I wanted to ask you about the consumer side. You mentioned that the transition shouldn't be at the expense of the consumer. There's obviously been the energy crisis recently. In certain countries, we've seen coal plants coming back online, prices spiking. So what reassurance is there here that we can give to consumers that we can sort of at the same time take coal offline, take gas online, and that renewables will fill the space without price spikes happening, and it will be an ordered transition? I mean, you use the word it shouldn't be messy. I mean, how can that actually happen in practice?
Yeah, thanks. That's a great question, Philip. But let me just quickly comment on what I've heard from the previous two discussants, because I think there's a really important dynamic. I mean, we can sort of discuss the last 4 or 5%, that where we might still need gas abated either with CCS or hydrogen. But the point being that if you think about new gas capacity today, you need to be certain that you can be part of those last percentage points. And you need to be able to make that case in the view of potential disruption from other flexibility solutions. And I think the report only looks at renewables plus battery, but obviously you have smart charging, EVs, sort of whole system solutions. You have obviously serious investments in energy efficiency and just cutting consumption as well. So you kind of, again, you're sort of the burden of proof really changes. You got to be really certain that you can be in those last percentage points. And then within that, you need to make that call whether you want to make yourself dependent on a carbon capture network. And Vesa rightly outlined that might be not the way to go for the power sector. Or you've got to make sure you're part of a hydrogen network and that hydrogen turbines actually become a reality, which they haven't yet. So there's, just to say, there's sort of a very long chain, and I think that's really what this report highlights. When it comes to your question around the consumer, I mean, I think first of all, a lot of the solutions out there, like cutting energy consumption, demand side solutions that the consumer is actually involved in, offer a lot of potential to make them more resilient towards energy price shocks. So I think there's sort of one takeaway here that every unit of electricity that isn't being consumed makes it better for the consumer. So I think that is sort of the sort of overall takeaway that's perhaps slightly independent from this report, but I think is really important highlight. But the other thing that really comes out is that we're already in a situation where we can see we have overcapacity. We're starting to have metrics to decide how we might, what plants might we want to shut down first. We probably need to overlay a energy system analysis to that. But what we want to make sure is that we don't build out that capacity even further, that sort of those additional costs aren't billed back to the consumer in the end, especially where markets aren't regulated, or where there are capacity markets supported through the taxpayer. And that sort of decision-making process, and this is where I come to sort of recommendations, is really about, we need transparency in that, we need fair competition as well, we need to make sure that other flexibility solutions can compete. We need to make sure that it's about the climate value that's really going to be realized and not just promises around hydrogen readiness and so on and so forth, that there are mechanisms that if you promise to be hydrogen ready by an X date, you got to deliver, otherwise you got to pay your money back, otherwise the use of taxpayer or consumer funding can't be justified. So these are some ideas. I think there's a lot about sort of that decision making processes, that they need to be independent, they need to be transparent, they need to be open to competition from other flexibility solutions. And I think we're seeing some positive examples in certain places, but I think there's still a long way to go in getting that paradigm shift here, and in getting out of those old habits of sort of supply side focus and sort of thermal generation focus.
Thanks, Lisa. And Lorenzo, related question. We've had a few questions about the price of solar panels, and that actually there's evidence suggesting that they're not going to continue to decrease in price, and that would obviously have an impact on your modelling. Could you comment on that?
Thank you. So that is a good question, and in a very short term, like it could be that due to the supply chain crisis, energy crisis that we are experiencing in the past months, that the cost of producing solar panel could slightly go up for a few months. But in the medium long-term perspective, like every studies we are looking at and every technology type of assessment tells us that the cost of solar will go down very quickly. And also there are different voices out there I mean, the more standard, well-known estimates from IEA, IRENA, they all agree that the cost of of both solar, wind storage will go down, but also we see that they're usually on the conservative side when they project future costs, while there is there are good opportunities. There are good reasons to believe that the cost of solar could go down even more quickly than they expect. So yeah, there is no question in our opinion that the cost of solar and wind will reduce further in the next years.
Okay. And there's also a very quick question while we're talking to you. Is there a reason why you've not included Russia in the analysis?
Yeah, not really, because we just started by looking at US and the European Union plus UK. So that is the only reason, but we're planning to extend our analysis to Asia in the next step. And probably we will look also at other major exporting countries like Russia.
Okay, great, thanks. Vesa, I wanted to ask you as well in terms of capacity mechanisms and whether we've got an increasing number of European countries that have adopted capacity mechanisms to maintain existing or even build more gas-fired power. So the trends don't seem to be necessarily going in the right direction, and whether other countries should take note of what's happening here.
Yes, thank you very much. I think capacity mechanisms and the whole security of supply really come to the deep center of what gas is used for in Europe. And certainly I think from my calculations, almost all of the major European power consuming countries now have a a capacity mechanism. I think Germany is actually the only one now that doesn't have one, even though although the new government has actually said that they will consider setting one up. And certainly security of supply and everything really come down to what is needed in the system. So to really understand why so many countries have a capacity mechanism, we need to take a little step back and look at what has happened in the European power sector. So in the past 10 years or so, Europe has closed something like 90 gigawatts of dispatchable capacity, most of it coal. And obviously this has been a very good thing for the climate and so on. And what has then replaced that 90 gigawatts is around 50 gigawatts of derated capacity. So most of that is solar and wind. And if you're wondering what is derated, that's basically taking the nameplate capacity and then derating it by the amount of electricity that is actually being produced by wind and solar. So taking this 90 gigawatts and 50 gigawatts, we end up with a net tightening of the European power sector by about 40 gigawatts. And this hasn't been a problem really, because the European power sector had a lot of overcapacity since the financial crisis and a lot of industry closed down. But this trend of not building enough clean capacity to replace the shutting baseload capacity, that trend is still ongoing. And everyone knows that it cannot go on forever. So, you end up with regulators and politicians and other policymakers starting to question, what if our situation or what if the day ends up being like very low wind? What if we have a couple of weeks of very low wind and cold and so on? And then they ask, well, who will be playing for, and what are the the implications of massive power cuts or brownouts and so on that we see in California, for example. And the consequences are quite drastic. So a lot of policymakers then come to the conclusion that, well, we need firm capacity and we need a policy to incentivize that there is at all times enough firm capacity in the system. And crucially, that doesn't mean that it runs a lot or that it produces a lot of energy. The point is that it's always there as a backup. So this is really key to understand also when it comes to when you hear about countries planning a lot more gas-fired capacity. The key word is capacity. Like in Germany, for example, you have some estimates that Germany needs 50 or 60 gigawatts of new gas-fired capacity. And that is not because they are running out of energy. They are running out of capacity for those crucial winter weeks and so on. So this is kind of my reflection on this, and ultimately that's really what for example the gas industry is focused on currently.
Thank you. I don't know if any of you wanted to come in on that and just comment. Jonathan, you look like you were ready to say something.
Yeah. So we accept that the capacity market mechanisms can and are playing key roles in some nations in ensuring system supply security, but just urge policymakers to ensure that over time these schemes are aligned with their long-term climate goals, and we do not have one set of policies undermining others. And Lorenzo touched upon this earlier, but we particularly question the need for these mechanisms to continue to support the operation and funding of large-scale CCGTs, the business models for which are predominantly based on assumptions that they will run baseload rather than offering the flexible short-term peaking supplies that the grid might need to back up renewables. So we think instead it's small-scale OCGTs that should be involved, which have much quicker startup times, around 30 minutes compared with the lead times of up to three hours for CCGTs. And CCGTs are largely profitable if used as steady load for long periods, but this is highly unlikely to be the case in the long run once we have a higher degree of renewables penetration in the system. But even those small scale OCGTs that we think might be required as backup will become more expensive to operate than renewables plus storage over time. So we just feel that policymakers must be willing to regularly review and restructure these capacity market mechanisms to ensure that they are eventually procuring capacity from a wide range of clean, reliable solutions, and that these policies are then aligned with wider climate aims.
Thanks, Jonathan. We have a few questions on hydrogen. Jonathan, do you want to take them and then others can chip in? Or Lorenzo, are you our hydrogen expert? And so I'll ask them and see who wants to take them. So basically, in terms of being hydrogen ready, somebody says, I heard that gas supply can never be 100% hydrogen. I think the max is more like 20%. And then the second question on hydrogen is, given the lower calorific value of hydrogen, do we think the maths adds up to use hydrogen to replace gas as was being described previously? Not a reason not to get rid of gas, but I imagine that would couple a lot of renewably generated electricity for hydrolyzing water. So could that electricity better be deployed elsewhere? Do you want to kick us off, Jonathan?
Sure. So we at Carbon Tracker, we've just recently started a new work stream focused on hydrogen with a view to early next year publishing a focused report outlining our clear view on the technology. But as I have mentioned, from our standpoint, we still just feel that there is a great degree of uncertainty over when exactly the technology will become commercially available to the power sector, and actually whether it will come in sufficient time, given that the power sector's contribution to economy-wide net zero by 2050 will, in Europe and the US at least, likely need to be completed by 2040. I think most estimates we've seen so far suggest that we're still at least 15 years away from hydrogen being available for wide-scale commercial power sector deployment. But that time frame still is by no means set in stone, and so again it means that there is just a substantial level of risk for developers for any new build gas that press ahead with projects under the assumption that they will at some point be able to retrofit hydrogen to ensure that their currently unabated asset will be able to run for its full planned lifetime. The situation may change over time, of course, if policy is introduced to support greater adoption and drive down the cost, but as things stand, we currently foresee hydrogen having a greater impact and role within the sectors that are hardest to abate rather than power generation. But as I say, we're going to be putting out a more focused report early in the new year on this.
Okay, great. Does anybody else want to add anything on hydrogen? Lisa or Vesa?
Maybe I would like to add a couple of points that I completely agree with what Jonathan said, and from a technological point of view, it seems that hydrogen can be used in modern gas turbines without investing too much in changing in retrofitting the plants. That seems like it's feasible, but what we really need to keep in mind are two things. Like, burning hydrogen will always, in a gas turbine, and the cost of the electricity, resulting cost of electricity will always be more expensive than than utilizing electricity from renewables and renewables plus storage. And the second point is what Vesa mentioned, that this solution should be really used to decarbonize that last 10, I would say even 5% of electricity generation. So of course there will be some moments in 30 years where there is a whole week without wind and very cloudy week, and we need some type of backup there. But that is the role that we see that those plants can play. And it's really important that we understand that the role of hydrogen in the power sector will be probably very limited in the future. And also because its need is quite a lot of higher value in other sectors like steel, industry, aviation, and so on.
Great, thank you. And just before we finish quickly, somebody's asked what role are US embassies and gas exporters playing at this point in pushing more European infrastructure, and how much do you think there is a push from other countries or who are clearly big gas exporters to want to continue with gas infrastructure? Jonathan, do you have any comments to make?
That's a good question. I mean, I think it perhaps comes back to energy security. I think when we talk about energy security, I think this is often only thought about at the national level and government's necessity to ensure the lights stay on. But when you consider the wider picture, European nations import the vast majority of their gas supplies, largely from nations that could well turn the taps off at any point, and there's a huge amount of political sensitivity and risk there, and as we have obviously seen this year, that this can result in a huge amount of price volatility, and these are risks that the renewables by comparison are not exposed to. So increasing our renewable capacity and adoption of battery storage ultimately gives Europe the opportunity to one day become self-sufficient with its energy supplies and not rely upon imports, and ultimately that influence from other countries on policy might not matter so much.
Okay, great, thanks. I'm really sorry, but I'm going to have to end the discussion. I feel that we're just getting started. we need another hour really, but there's lots of questions we haven't managed to get to, so I encourage anybody to get in touch. I'm sure all the panelists will be more than happy to answer questions via email after the event. And I also wanted to read out a comment that we've had in the chat that says it's most refreshing to be on a webinar where people disagree but can have a reasoned and respectful argument. Well done all. So you can all give yourselves a pat on the back that we discussed in a good manner. So I'd like to thank all our panelists today. This is clearly a question which is key to the energy transition in Europe and elsewhere. And as I said, if anybody's not had their question answered, then feel free to follow up afterwards. Thank you very much, everybody. Have a good afternoon or evening. Thank you. Bye.
Thank you very much.
Thank you.
Bye.
Thank you, everyone.
Thank you.